Hello, I'm Amber with Canary Capital. Thank you for joining us on our monthly webinar. Today's topic is after Jackson Hole, rate liquidity in the seventh inning of crypto. And I guess we'll just jump right into it. And Stephen McClurg, you want to start off and let us know the next 90 days?
Absolutely. Well, thanks everybody for joining us. Um, I'm not going to talk a whole lot about our fund strategy, but I will mention that we run a risk managed fund strategy for crypto. And one of the techniques that we utilize is investing in bonds and taking risk off as opposed to using derivatives or shorts when we see the market changing direction, which is exactly what we're here to talk about, what we expect to see. So here with my colleague Josh, who runs our trading and portfolio management program, and I was in Jackson Hole last week, talking to several other asset managers, other people in the crypto space, economists, and of course regulators and Fed members. One of the things, one of the strongest themes was something that we've been talking a lot about lately, and that was, of course, rate cuts. We actually published a piece a few weeks ago suggesting that the Fed should cut rates, even though I believe that inflation needs to be tempered. Even though inflation has come down quite a bit from where it has been in the last 4 years, we're back down into the 2 to 3% range, which I think is good, but we still need to offset a lot of inflation that occurred over the last 4 years. So even at a 2% rate, that actually doesn't help where prices have gone. I would like to see inflation even lower, an even lower rate than this for an extended period of time. I also, despite what a lot of pundits are saying, I do believe that the labor market is still too hot. And and of course, the Fed came out last week saying that the labor market is trending in the wrong direction, meaning that there's slower job growth, but anytime that unemployment is below 5%, that's actually too low. That's actually too hot because it doesn't leave a lot of slack for the labor market, because people do change jobs, people do take time off, people do retire, and a lot of those factors, even though they are considered, it does leave considerable less slack in the market. So I would like to see those factors go before any kind of significant policy change by the Fed. That being said, there's two things that the Fed controls. One thing that the Fed can control is short end rates. And at the moment, we've got rates that are on the low end. The Fed's fund rate is actually higher than the 10-year. It's higher than the 5-year. It's higher than the 2-year. And that's problematic because you should be rewarded for more duration risk that you take. The other thing that the Fed can control is the actual balance sheet, which is still at extremely high levels, historically high levels. And even as a percentage of GDP at 25%, it's extremely high balance of $6.6 trillion. The way that the Fed can actually work both sides of the math is by lowering the Fed rate, which would actually bring short end rates below the 10-year. And specifically, I'd like to see it below the 5-year and the 2-year as well, so that we have a normalized risk curve. But you don't want the 10-year to come down too much. So 10-year should be right around 4.25, 4.5. And I know that hurts the housing market, but housing is also overheated and it's starting to come in. And housing is largely unaffordable right now as a percentage of earnings. So we do need to see housing coming in. We need to see housing cool off. And the way to do that, again, is to lowering the Fed rate doesn't actually affect mortgages unless it drags the 10-year with it. But the way that the Fed could actually manage it is lowering the low end, and then, of course, selling off assets on the balance sheet that represent the 5 to 30-year part of the curve, which is a significant part of the balance sheet. This would actually stabilize the 10-year or even bring the 10-year up to a 4.5% level, which is normal. So the Fed could do those two things, and I'd like to see the Fed do those things. Now let's talk about what we expect to see the Fed to do. Chairman Powell has been put in quite a predicament by the president, calling for him to lower rates, attacks on the Fed. And by the way, they're not entirely unjustifiable. The Fed has been a bit political over the last few years, lowering rates when inflation was high and unemployment was low right ahead of the election, and then holding off when we actually need the low end to come down. So I don't agree with the president that a 3-point cut is justifiable. There's other people that say 1 to 2-point cuts. I think really all we need is 75 to 100 basis point cut in the Fed rate to start with, to get us to a reasonable level that's still a bit restrictive, and possibly another cut in 2026. So what the Fed has done to address those concerns is said that they're kind of throwing inflation out the window because they can't really look at that anymore. They have said that they're going to really focus on unemployment, which is trending the wrong direction. So based on that rhetoric, I believe that the Fed is going to cut 25 basis points in September, and then another 25 basis points in October. There's a possibility that there's another 25 basis point cut in December. And I do hope that that happens, but I'm not sure. So I need a little bit more data and analysis and more rhetoric before we make that claim. So how does that affect, how would those two cuts actually affect the markets? Well, markets obviously go up when there's accommodation by central banks. And central banks around the world are already accommodating, which is growing into global monetary supply. So if the US were to cut rates, cut the Fed rate, even if they were less accommodative on the rest of the curve, that should cause risk markets to rise. And what I believe, based on the data we have right now, and if our assumptions are right on cuts, I do believe that after the first cut in September, markets will likely rally. Bitcoin will likely go to its natural state, which is about $140,000 based on global M2 monetary supply, and then possibly rise up even to 150,000 by the end of October. There's a lot of people that are a lot more bullish than I am, but from where Bitcoin is at $110,000 right now, that is a pretty significant rise of 25% on the high end. On the low end, I'm targeting about 15 to 20% increase. I do believe that, again, based on what we know today and based on the data we have and the current rhetoric, that after the second rate cut in October, we will likely see a peak in Bitcoin price, maybe followed by a short rally in alts before that peaks as well. Several factors that are contributing to the Bitcoin rally and the alts rally is, number one, of course, rate cuts will force it higher, but usually markets get ahead of themselves and anticipation of rate cuts, they'll rally, and then when the second rate cut happens, we probably start topping off because now it's happened and Bitcoin's already run to that point. There's also still several treasury companies coming on board, and not just Bitcoin, but other cryptocurrencies that are driving markets up and will continue to have buying pressure in the market. And then, of course, we do expect to see several altcoin ETFs launch probably in October. And the generic listing standard for altcoins is public. It's still going through a comment period. It's still going through a review, and then, of course, an approval period. but we all know what it is. So if you look at the generic listing standards, you can get an idea of what exact altcoins will be likely listed in ETF and likely in October. And usually, and this happened 4 years ago when we, as the Valkyrie team, some of us were at Valkyrie, launched the first Bitcoin futures ETF in October of 2021. That did mark the top of the market. People bought Bitcoin ahead of time in anticipation of the event, the futures ETF launched, and the top really started setting in. Interesting enough, that the timing with ETFs, the timing with rate cuts, and then of course, the rest of the market activity all happens to coincide at the end of October. So that is my near-term prediction on where the peak in Bitcoin is. Altcoins will likely rally through November, and then I do expect another bear market cycle. Bitcoin and the rest of crypto still runs on a 4-year cycle. There's a lot of pundits that saying that it doesn't anymore, that it shouldn't anymore, that we've gotten beyond that. But the reality is that miners, even though every time there's a halving, there's less and less influence. The influence is still there, and miners will typically, at this point in the cycle, have to sell more Bitcoin than they're making to pay the bills, and that selling pressure is a constant selling pressure that will continue to affect Bitcoin. Now, in future years, I do believe that the halving will have a smaller impact on mining activity and mining selling activity, but that's the way Bitcoin was designed. That the waves go smaller and smaller on a percentage basis as time goes on, but that is still in full effect. I also don't believe that the global economy is as strong as it has been, and 2026 could see a very, if not flat GDP growth, maybe slightly negative GDP growth in the US, and we're already seeing that in other economies around the world. So yet a third reason why a bear cycle works here and coincides. And of course, what we plan on doing is, watching the data very closely. We always lay out a roadmap for future years. We expect to follow that roadmap unless the data changes, unless circumstances changes. But if I were to follow the roadmap that we have in front of us right now, is, moving into October is where we start taking risk off the table, October through November, and then start slowly moving into a barbell strategy where we're managing bonds on one side, crypto on the other. And even in a bear market, you can make money trading. So we will, but we will be trading, probably much more heavily in bonds on that side of the barbell through 2026. So that's my overall market commentary, and I'll hand it over to Josh.
Sounds good. Thanks, Stephen. Before we go, excuse me, to my portion, let's do a few rapid fire macro questions that I'm sure people are curious about. I'm curious about. The first one regarding inflation. Do you think the tariff effects of inflation are behind us? Is there more in front of us than behind us? Do you think it's going to be a one and done price hike? Is this going to be like a rolling situation where we have just, different industries experiencing inflation at different times? Any comment on the tariff stuff?
Yeah, I think the news and political pundits have really overdone the effects of tariffs on the economy. The reality is, there is a certain amount of price elasticity, and people are already stretched. So what happens if there's what happens if there's a 50% tariff on China? Because it does change all the time. What's going to happen is you go into your local Dollar General store or your local Walmart, and all the junk that they sell there is going to go up in price, and less people will simply buy it because there's a lot of useless things that are being manufactured. What's happened since the last financial crisis is that there's a lot of zombie companies globally that are manufacturing, producing, and selling things that people really don't want. And because debt had been cheap, they're basically selling these manufactured goods for less and less money, even though the market really doesn't demand them. And at a certain price, people want them. At a certain price, they don't. But they've had to lower the prices in order to push this out. And that revenue has been what they've been using to just pay their debt, you know. But these zombie companies exist. If the prices actually go up on a lot of these, you know, I would say cheaper tech, electronics, toys, you name it, items coming out of China, people will simply stop buying it. So it will actually cause those companies to manufacture less. And we're already seeing the data, the manufacturing data out of China and India and several other places that show that they are slowing down because they cannot sell these things at a higher price. So I actually expect even automotives. I mean, people were afraid that, you know, cars were going to go up 20%. Well, automotives is actually, if you look at CPI, there has been a barrier of where people will actually stop buying. And we are at that barrier on several products. So tariffs really won't have that much of effect. A lot of the cost is going to be absorbed by the manufacturer. There's going to be less things manufactured. So of course, there's going to be an initial bump in price. And then as people stop buying things, those prices will begin to come down again. And you can even look at the inflation data and see that that the rate of inflation has actually gone lower. The only thing that's massively higher is energy cost, and that has to do with all these AI data centers coming online, causing electricity costs to go up. So most of the inflation that you're seeing is due to AI, actually not tariffs. But in the long run, as manufacturing activity slows down, inflation kind of catches up, people will start buying again, and then you will see inflation coming back into play, but probably in a much more muted way. So I'm not worried about the tariffs for the most part.
Got it. You talked about unemployment a little bit and the numbers. There's been a lot of talk about the revised numbers. I wondered if you have any comments on that. And then the second thing would be, we've had a lot of people discuss the immigration picture and the fact that the previous job creation numbers we've seen, we probably won't be seeing going forward because of the decline in immigration. So any thoughts on that? And I've seen people talk about the job creation side of it. I haven't seen people discuss like the initial claims side of it for unemployment, where we seemingly have this level above 260,000 that maybe like the key level where the alarm bells start going off. But if we have less job creation, maybe that key level is lower, right? So
Yeah.
any thoughts on that?
Yeah. So one of the most important parts of our agriculture economy is migrant labor. And some areas are affected more than others. You know, if you're in the Midwest, you're not as concerned about it because it's a lot more mass produced things like soy, wheat, corn that is easily harvested by machines. So there's a lot less labor cost there, more machinery cost. But when you get out to places like California and Arizona and, you know, Oregon, Washington State, it's a lot more it's a lot more manual, right? So that's where you've got, like, you know, a lot of different types of fruit and nuts, and that agricultural sector is highly affected by migrant workers. What's to be seen, and you know, and knowing farmers, is there is a process to hire migrant workers on a fully legal basis, and that's usually what happens, right? I mean, there are a lot of people that slip through the cracks, but for the most part, these are temporary work visas where people come in. But we will see if there's more restrictions there. If there's too many restrictions and we don't have the migrant labor force to come in and actually pick the produce, then we could probably see, fruit rotting on the trees and agricultural products going up in cost. So that actually will cause some inflation, but on the other end of things, we will have less labor overall. So I do want to see unemployment grow a little bit because we're going to have to make up the slack there.
Got it. And we talked about housing a little bit already. You laid out your plan to bring housing costs potentially down. What if that doesn't happen? So on the left here, we have the median housing payment as a percentage of median income, and that is well above anything since 2000. We also have delinquencies rising on a lot of loans here. Is there like light at the end of the tunnel if housing, do we need to build more? Do we need to rezone commercial real estate? Is there a plan here out of this for people like me who don't own a house?
Yeah, exactly. Well, I'm going to start with the chart on the right first, right? Because a lot of the loan types on that chart that's problematic is actually tied to short end rates. So the Fed reducing the Fed rate would actually cause credit card interest to go down, which should help in that area. And you see the big spike in credit card delinquencies. Student loans had a massive delinquency. Now that has more to do with short-term forgiveness and then all of that forgiveness coming back than anything else. But a lot of student loans are tied to short end rates. So lowering the short end would help with student loan servicing, credit card servicing, auto loan servicing, revolver short servicing, which actually isn't spiking too much right now. Mortgages, oddly enough, are still pretty low on the delinquent area, and that had a lot to do with the reforms that came after the financial crisis 15 years ago. So again, going back to the left side, which is mortgages. Mortgages are affected by the 10-year primarily. If the 10-year stays where it's at, we're already seeing housing activity slow down significantly in a lot of metropolitan areas. So as long as the 10-year stays above 4%, we should see housing continue to hold or slow, and in a lot of cases, price dropping. But again, if you look at this chart, median housing payment as a percentage of median income is extremely high after 2020. We need to get that back down to about 30% to 35%. And the only way to do that is to hold the 10-year where it's at long enough for prices to come back to normal as a percentage of median income. So my hope is, again, that the Fed lowers rates to help out, the consumer side, but hold rates high on the high end to get housing back down to earth.
Got it. And we've talked about DXY a lot. I don't have any questions for you, but the dollar is still at a very weak spot relative to where it was when Trump was elected. And if we do see similar, a mirror or an echo of anything like 2017, which is where the Trump 45 USD weakness is sort of looking after, it would make sense that if we do have this strength upcoming here in Q4, that we do see some more dollar weakness potentially. So that's a very good sign for crypto if we continue to see dollar weakness. And as Stephen already stated, globally, we're seeing rates come down across the board, and that's helping accommodate, conditions to perk things up a little bit for good reasons, for bad reasons, for whatever reasons. If you go and you look at, the European version of the S&P or the German version of the S&P, all of these markets, for the most part, are pushing all-time highs here. Whether or not that's good or bad, that's just what's happening. And I think this is a part of it, certainly. And when we put all that together, I'm sure if you're watching this presentation, you've seen some version of this global liquidity index. in the green there, which continues to sit at highs and move slowly higher. As this does move higher, so should anything that is reliant on a fixed asset like gold, like Bitcoin. We tend to see both of these follow the global liquidity index pretty closely. One thing to keep in mind here, I personally think the gold chart looks crazy good here relative to BTC, relative to any altcoin. It's been coiling, gold's been coiling for months. And the reason that's important to pay attention to is if gold starts to break out in September or in Q4, it's unlikely that Bitcoin moves in the same direction at the same time. It's very good for Bitcoin to see gold go higher, because down the line, that would mean a higher BTC price. And ultimately, both are affected by global liquidity. So dollar weakness, global accommodation in economic conditions, and gold moving higher. These are all things we like to see on the crypto side. One thing I want to mention as we transition to the crypto side of the presentation, we hear a lot, even today, even yesterday in a call we were in, people sort of saying, oh, well, we can just create Bitcoin. We could just create 2 more Bitcoin networks, and we could just keep creating them, right? You and I, we can do it on the call right now. We can create Bitcoin 2.0, Bitcoin 3.0. But it's important to remember, leading up to the launch of Bitcoin, there was 40 years of R&D that got put into this thing. A lot of people remember BitTorrent, other things here that you may or may not have used or heard of that have led up to this moment. And from the Bitcoin launch, we have the brand, we have the network, we have the miners. We're seeing several proof of work networks already transition to proof of stake. So there's kind of not too much room for more than one winner in the big proof of work ecosystem. So I think it's much easier to create EVM networks, smart contract networks, proof of stake networks than it is to reinvent BTC here. So that really, to me, sets it apart from the rest of the market. If we look at Bitcoin as an investment, start talking the language of people who why should we care, right? Why should anybody care? Well, let's make the case. Again, many people have seen this already. And if you want to talk more about this data, you can reach out to us. But if we look at the 60-40 with and without BTC to varying degrees, taking away from the stocks or the bonds portion, the data is the data, right? So, the history, the past isn't the future, obviously, but there's clearly been a beneficial effect towards total return adding BTC to a portfolio. You can't necessarily say that yet, I think, about most altcoins. I think we just need more data. We don't have as much data on most of the alts as we do BTC, but there could be a world down the road where you start to see in the alts portion of a portfolio allocation some sort of high risk, altcoin sleeve. I could see that, especially the younger crowd who loves the altcoin side of things. And the other part of this is people often say, Bitcoin's too volatile. It's not a store of value. What else do they say? It doesn't help you against inflation. And in the day-to-day time frame, when you're marking to market every second of every day, including the weekends, it may feel like things are highly volatile, but the direction of travel here, if you're denominating this in the median price of a home, or if you're denominating this in average hourly earnings, it's pretty clear. Yes, it's been volatile, but the general direction here has been highly beneficial and in your favor. So yes, in a quarter-to-quarter basis, outright head-to-head against inflation, BTC may have some headwinds or tailwinds based on inflation expectations and whatnot. But historically, this is the data, right? So when you think about the headlines and you hear people say this stuff, you can use this as ammo and say, look, this is what happened. The cost of a house has gotten cheaper in Bitcoin terms. That's just, just is what it is. And another thing relative to gold, we've talked about this before too, but gold obviously has thousands of years of history. Bitcoin has 2 decades-ish. Looking at the gold inflation versus the BTC inflation annually, BTC is actually below the estimated gold inflation. And I'd imagine more gold is being pulled out of the ground the higher the price goes, at least, attempted to be pulled out of the ground as much as possible, just because you get a better price for it now. So you can't really do that with BTC. The amount per day is fixed. The network adjusts for a targeted BTC per day amount. And you can see the daily inflation there in the orange line. It'll oscillate around a level, but you could try to pull more BTC out, but on a network basis, you can't. You only get what you get per day. Stephen talked a lot about cycle expectations from a macro perspective. If we look at the historical comparisons between the 2016 cycle, the 2018 cycle, and we count the days since the cycle low, we are in day 1008 here. So historically, we haven't seen too much more in the cycle. That's why in the open, when we talk about seventh inning, it may be later than the seventh inning, maybe, the eighth inning, we may see extra innings, whatever, but it's certainly a different time today than it was, when FTX blew up, for those of us who are around and remember that. And yes, the cycle can keep going. We will adjust as the data presents itself, but sitting here today, we are mentally positioning for what 2026 is going to look like. And we are very close to approaching target expectations for BTC. And I think this is another reasons why people are rotating heavier into alts. It's easier to push those up. Those haven't really gone anywhere over the past couple of years, especially something like ETH, which we'll look at in a second. But, we're at what, 110, 112, 150 from here, percentage wise, is certainly smaller than what you can get on many of these altcoins as people move down the risk curve. And we're kind of seeing that with the flows on the ETF side as well. So for BTC and ETH, 2024 to mid 25, it was all about BTC ETFs. It was all about those flows, setting records, breaking records. And over the past few months, as the ETH price picks up, all of a sudden, everybody loves the ETH ETF, right? So price solves a lot of problems. It smooths over a lot of concerns as momentum picks up. And you're seeing the ETH BTC ratio pick up. You're seeing flows heavily in favor of ETH relative to BTC, even on a day-to-day basis. Yesterday, we had 88 million in for BTC, and we had like 455 million in for ETH. So there's still a heavy focus on not BTC. And that just means the path of least resistance here, just based on flows, unless there's some catalyst otherwise, certainly favors the non-BTC stuff the rest of the cycle. As a BTC maxi, I don't like to hear that, but that's just what it is. And if we look at, again, cycle expectations, monthly returns, this year's yearly year-to-date return has been pretty muted for BTC. Again, expectation is 2026 is a down year. And if we look at leading into October, Stephen was probably more bullish than the data would suggest on September. But either way, October undeniably is one of the best months in legacy markets. It's one of the best months in Bitcoin and Ethereum, and certainly altcoins broadly. Altcoins, like Stephen mentioned, typically get this bump after Bitcoin's peak as people are rotating into the next thing. So it would make sense to me that timing wise, we do see some rotation slightly later in the quarter in Q4, but having tempered or muted expectations maybe for September, and setting ourselves up for a run in October, November, December, perfectly reasonable based on what we've seen historically. Aside from global liquidity, we can also look to technical analysis and say, okay, based on price action, where do we think the possible moves are here still? Throughout 2025, most of it was setting up for what would be a cup and handle in technical analysis. You take the depth of that pattern, you measure it higher. We still have that target yet to be hit on price. That range is 140 to 160. That's within the wheelhouse of expectations. And 122 would be the mathematical key level to breach based on highs and lows of the previous year. So that, for me is like the near term. 122 to 150 makes total sense. Beyond that, we'll see what we can get. Altcoins have been picking up quite a bit. This is the total market cap, monthly BTC, Ripple, ETH, Sol. You can see those bars are gaining a little bit on a relative value basis on market share. If we break it all down, distill it to one number, we can look at Bitcoin dominance, and that has started to roll over. If Bitcoin dominance, that's Bitcoin versus everything else. If Bitcoin dominance goes from 65% to 40%, that's a pretty significant bump in the altcoin market. That 40% level is generally what we've seen historically. That's why I pointed out, this says, hey, if we're at 56 today on dominance, there's a decent move yet to be had here on the altcoin side, potentially. Other than just price, fundamentals are a part of this. You never want to see price moving up with on-chain activity do nothing. You want to see, in this case, ETH, daily transactions hitting all-time highs, which is exactly what you want to see. You want to see people actually using the chain. Unfortunately, because of L2s, the ETH burn component has really stagnated. For Ethereum specifically, you can use a scaling solution. It's a separate chain. It's a separate coin. It's a separate ecosystem, which is kind of acting as a parasite on ETH. But the point of this is they have a burning mechanism on ETH that has sort of stagnated. And just like buybacks for stocks, that burn component has a bullish, tailwind to allow to absorb a supply soak, right? So if you have less of that, then it's harder to push price up. But we're seeing so much flows into ETH right now that hasn't really mattered, right? And if we break down these L2s and we look at, okay, who are the winners here? Arbitrum specifically has gained a significant amount of market share away from ETH. And if we look at why, it's because it's so cheap. It's fractions of a of a cent almost on an average transaction basis. It's very, very cheap relative to ETH. And it's quicker, it's faster, it's easier. When I transact on ETH, I use Arbitrum. Most people do, so not really using ETH, the layer one. And if they were, I'd imagine the ETH price would actually be higher. It's just you're competing for these other transactions on the layer twos. Something else to pay attention to here for the rest of the year is the validator queue for ETH. The staking mechanism is seeing people leave the ecosystem to a pretty big degree, to the tune of around 1 billion ETH. That may dampen price here in the near term. We'll see. We sort of hit this level, and there's still a lot of treasury companies buying. There's still a lot of flows coming in, but we are temporarily hitting a little bit of a ceiling. So it's going to be interesting to see if the validator queue clears. What does the ETH price look like after that? Here's a technical analysis view of ETH. 8 to 11 would be the measured move here on ETH on a high time frame. Certainly wouldn't expect that today or tomorrow, but end of cycle targets, totally reasonable, just based on what we've seen since 2024. We also have a lot of alts here that are basing. This is probably hard to see on an individual basis, but collectively, Solana, Cardano, Sui, Arbitrum, Injective, Algo, AVAX, there's many, many more. They collectively haven't really gone anywhere since 2025 year to date, and they're still down year to date. Whereas Bitcoin's up 20, ETH I think is up somewhere around 30. These tokens Sol maybe break even year to date at this point, but I think this is where a majority of traders are going to look to a risk reward opportunity. Whether any of these get rotated into, who knows? But just purely from what hasn't moved, this is how the altcoin trader mind works. They're looking to the next thing. that's all we have for this presentation. Thank you for stopping by live or in the recording. And I don't know if there were any questions in the chat, but if there were, we will try to answer them at this point.
I'm not seeing any other questions.
Yeah, I don't see any either, but I always have a hard time pulling that up.
When do you think Bitcoin tops?
Stephen was mentioning October. I think that's reasonable. I think November is reasonable. Thanksgiving tends to be a very interesting time for the market, just because if things are doing well, they tend to do additionally well after Thanksgiving, as people sort of get together and talk about, you know, as you're talking to your uncle or whoever, and you're sort of spreading the seed in their mind to buy other stuff. So I'd imagine October, November, and in 2017 it was December, January. There tends to be a lot of yearly annual rebalancing that takes place. So if BTC ETH or whatever is up by a high percentage, certain people tend to wait to pay off their taxes to the following year. You know, if you take profit on January 1st, you push off your tax burden till the year after. So that's also something to think about. But I can't imagine, we'll see, but I can't imagine we do anything super constructive in Q1 2026.
Another one from Eduardo. Would an odd October bad month invalidate the Q4 thesis?
I don't think so. It's going to be hard, like Stephen mentioned, with rates coming down. Maybe that's all priced in already, but we'll see. You know, that it's possible September's great, October's not. That would be very against what we've seen historically, and against, I think, rate cuts coming. But I guess it depends how much of that is priced in for the moment.
Okay.
Well, we really appreciate everybody's time. Thank you so much for joining us. We will see you all again in a month.